Understanding withholding tax in the context of the corporate tax law. Overview of withholding tax. Withholding tax is a mechanism used in taxation systems to ensure the timely collection of taxes on income derived by non-residents from sources within a particular jurisdiction. It operates by mandating that a resident person who makes specific payments to a non-resident deduct a portion of that payment as tax. This deducted amount, referred to as withholding tax, must then be remitted to the tax authorities. The purpose of this system is to facilitate tax compliance and minimize the risk of tax evasion by non-resident entities earning income from local sources. Withholding tax rate at the enactment of the corporate tax law. At the time when the corporate tax law was introduced, the rate of withholding tax applicable in the jurisdiction was established at 0%. This means that, in practice, no withholding tax was required to be deducted or remitted to the Federal Tax Authority, FTA, by resident persons making payments to non-residents. The decision to set the withholding tax rate at 0% reflects a policy stance aimed at supporting an investment-friendly and competitive tax environment that minimizes administrative burdens on both local businesses and international entities conducting business in or deriving income from the jurisdiction. Mechanism for deduction and remittance of withholding tax. When the rate of withholding tax is in effect, resident persons who make payments to non-residents for specified categories of state-sourced income are required to 1. Deduct withholding tax from payments. The resident person must calculate and deduct the applicable withholding tax amount from any payments made to a non-resident. This deduction applies to designated types of income derived from the jurisdiction, such as royalties, interest, dividends, or other state-sourced income, as defined by the relevant tax laws and regulations. 2. Remit withholding tax to the Federal Tax Authority. Following the deduction, the resident person is responsible for remitting the collected withholding tax amount to the FTA within the time frames and in accordance with the procedures specified by applicable tax regulations. This ensures that tax on income earned within the jurisdiction by non-residents is collected at source and properly accounted for. Tax credits for withholding tax deducted. For taxable persons who are subject to withholding tax deductions on payments made to them, tax credits are available. These credits serve to mitigate the potential for double taxation by allowing taxable persons to offset any withholding tax deducted from their payments against their overall tax liabilities. In this manner, the withholding tax mechanism promotes equitable treatment and ensures that taxpayers are not unduly burdened by taxes deducted at source. Implications of the current 0% withholding tax rate. Given that the withholding tax rate was set at 0% at the time of the corporate tax law's enactment, there is currently no requirement for resident persons to deduct or remit any withholding tax on payments made to non-residents. This means that, effectively, the withholding tax mechanism is inoperative for the time being, and payments made to non-residents can proceed without any deductions being made at the source. The 0% withholding tax rate is a significant feature of the current tax regime, as it underscores the jurisdiction's commitment to fostering an attractive business environment and reducing administrative complexities for businesses involved in cross-border transactions. However, taxpayers should remain vigilant to any potential changes in the withholding tax rate or applicable rules, as adjustments to the tax rate could impact compliance obligations and the tax treatment of payments made to non-residents in the future. For more details, contact us.